Okay, communicating and interpreting accounting information. So we're not actually going to learn a lot of new accounting entries or terms in this lecture, but it's going to be pulling together a lot of what you've learned. So believe it or not, you're actually quite competent at this point in reading financial statements. So this shows all of the parties involved in the accounting communication process. Remember that accounting is a language, right? It's not just numbers on a page, because it's people care about what the numbers mean, right? So let's look who's involved. So we have management. This is management of ePhone, okay? The CEO, the CFO, the accounting staff. Okay, they have primary responsibility for preparing the financial statements. They're the ones who say, here's our revenue, here's our accounts payable, here's our cash, here's our balance sheet, statement of income, statement of cash flows, here's how our numbers look. And there's a lot of people who care about these numbers, right? Directors, this is the board of directors. And they are elected by the shareholders, us. So again, we elect a board, and the board of directors provide oversight. Okay, they oversee management. They decide who the CEO and CFO are. They decide if they're performing well, right? If they need to fire the CEO, or how can they incentivize their senior executives to perform well. Okay. Auditors. Auditors serve the role of verification. They verify the numbers that management says are true. So as you can imagine, if the CEO, if his bonus is based on how much revenue the company made this year, you can imagine that the CEO has an incentive to make the company look better than it is. And it's not all that hard to book journal entries that are dubious and aren't really supported by economic substance to make the revenue look really, really good so that you can get your bonus. Okay? You as an investor would not be happy with that. Not only is the CEO getting a bonus when he shouldn't, but you're making investment decisions based on the performance of this company, right? If you're a bank and you're deciding to loan to this company, you might say, oh, they have 10% revenue growth. Last year the revenue was $1 million, now it's $1.1 million. They're doing really well. I'll loan to this company, right? If you're an investor, the same logic applies. You care about how much profit the company makes because that'll impact the potential for your dividends, the value of your share, right? Your share price. So again, you care about how the company's performing. If you're being lied to and you decide to invest more money and it turns out the company was in fact losing revenue, revenue was declining. Let's say revenue went from $1 million to $900,000, you wouldn't have invested. When it comes to light, because these accounting frauds always unravel, it takes a few years, but it almost always comes to light, and the share price goes from $100 to $1. You've just lost all your money. And you say, well, you wouldn't have invested if you had known that the revenue is actually declining, right? So you suffer financial harm. So you say, we need to hire an independent third party to verify all of the numbers, to make sure that they're accurate. Okay, so the board of directors forms a subcommittee called the audit committee. Okay, and the audit committee appoints an auditor. Okay, the auditor comes in at the end of every year and they get paid a lot of money, millions of dollars, literally millions of dollars a year, to go in for 6 weeks and pore over all the books. That they look through all the accounting records and they get comfort that the revenue number is accurate. All the expenses are true. The liabilities are there. So think about the incentives, right? The incentive of management to make the books, the accounting records look better than they are would be to overstate assets, understate liabilities, overstate revenues, understate expenses, right? So think of what it means to overstate assets. That means more debits. To understate expenses means fewer debits. Almost like moving, rather than calling something an expense, you call it an asset. All our journal entries have debits and credits. Okay, it's just which account do you debit and which account do you credit. So if you're debiting an asset when it should be an expense, not only are your expenses higher than your assets higher than they should be, but your expenses are lower than they should be. Flip side, revenues and liabilities. Again, if you're a company that wants to get more bank debt, you don't want to show a lot of existing debt on your balance sheet. Okay, so your incentive, rather than having the credit be a liability, you want a credit to be a revenue. So not only are your liabilities understated, your revenues overstated. Okay, so the auditor they focus their attention on these things. Yes, they care about overall objectivity and accuracy, but it's more likely than not that assets will be overstated than understated. And it's more likely than not that the liabilities will be understated than overstated, right? So the auditors provide a verification role. And if you want to become a CPA in Canada, which is a chartered professional accountant, you have to be an auditor for 3 years. You need a certain number of hours, I think it's like 1,500 hours or something, auditing, before they'll give you the letters behind your name. So who else? We have a few other parties. Regulators. So regulators, standard setting, and they also perform a verification role. So standard setting meaning the accounting standards. So if you think of IFRS, International Financial Reporting Standards, you've seen a bit of them. It says how you have to account for certain transactions. The transactions we've seen so far, there hasn't been a lot of judgment involved. But we know we have to use the accrual basis of accounting. What does that mean? It doesn't matter if we get the cash or not. If we've provided a revenue or we've incurred the expense, we have to record it. That accrual basis is set by the regulator. Okay? And the regulator wants to make sure there's a standard set of accounting rules for all parties. Management doesn't get to choose, or they shouldn't get to choose, how they book a lot of these entries. Okay? The standards are set by regulators to remove the ability of management to make their books look better than they are. Okay? And then we have users of the financial statements, and they use this for decision making. Institutional and private investors, lenders, customers, suppliers. If you're a supplier, let's say you've already extended a lot of credit to a customer who, let's say you've been shipping this customer inventory, okay, and they haven't paid you yet. You've been shipping them inventory for 6 months, and they keep promising to pay you and they haven't paid you yet. You might be reluctant to send them the next shipment because you might think something's going on. If you send them $100,000 worth of inventory and they go bankrupt, it's highly unlikely you're getting that inventory back. So you might ask to see their financial statements. And based on their financial statements, you might see they have $1 million of bank debt and they have revenue of $200,000 and it's declined from last year of $500,000. You might think this company's in trouble. We're not going to send them any inventory until they pay our existing balance, right? So there's a lot of people involved in there's a lot of users who care about the financial information. And then there's information intermediaries. So these are financial analysts, okay? So they don't directly make investment decisions, but they offer analysis and advice. So for those people who weren't lucky enough to take AFM 101 in their undergrad, they might not know anything at all about the financial markets or about accounting statements, but they might have money that they want to invest. So they go to a financial advisor. And the financial advisor will say, Google's a good stock right now and Facebook is a bad stock, and here's why. And they'll be able to look at the financial statements and say, oh, Google has no debt and revenue's growing, positive net profit margin, they're industry leaders, right? So they don't make the decisions directly, but they might have clients who make decisions based on their advice. Now, my opinion is a lot of the work they do is not relevant, but I mean, that's a separate sort of argument. So there's a lot of people who care about the financial statements. Here are some examples of regulators. So here we showed regulators as one sort of group up here, right? But there's a lot of different groups. Regulators, Canadian Securities Administrators, the CSA, their primary responsibility is to protect investors and maintain the integrity of the securities market. What on earth does that mean? So the Canadian Securities Administrators believe that generally investors aren't very smart, that you and I aren't capable of handling our own money and we can't make good investment decisions, okay? So we need protection. And that's why if a company is found to be lying on its financial statements, their stock will be delisted. We can no longer buy that stock, buy that security. Okay, they can be fined if they're if you're listed on a stock exchange, on the Toronto Stock Exchange, the TSX, or the New York Stock Exchange, the NYSE, you have to provide to the securities administrator within 90 days audited financial statements. If you don't provide the audited financial statements, they can halt trading. They can say no one can buy or sell your stock, right? Because again, they're worried that from an investor's perspective, you don't know that they haven't submitted their audited financial statements. That's usually an indication that something's wrong, right? If there's a problem with submitting their audited financial statements. Maintain the integrity of the securities market. So they want to make sure that this market functions as intended, meaning information is readily available to all investors, right? They disclose that the companies disclose their financial results in a timely manner. They're representing faithfully as to the results of the year. And they want to make sure that it's a well-functioning market. The Accounting Standards Board, they set the generally accepted accounting standards, which are referred to as GAAP or IFRS. Okay, so here's a good question. Remember we saw here that the auditors go in and verify the financial statements, right? They make sure that all the revenue is accurate and expenses are accurate. Now here's a problem. If you're an auditor and you're getting paid $1 million by your client, and there's another auditor who says, I'll do the work for $900,000, if you're the client, you say, yeah, I just want the cheapest audit possible, right? You don't even want the auditors there, right? They're a nuisance. So there's probably what's called an independence issue. And that means even though you're supposed to be auditing the person to say whether the company, to say whether or not their financial statements are accurate, they're paying you. And there's intense competition for this work. So if you uncover a problem and you go to the CEO and say, how come you're booking so much revenue? And he says, well, we'll just go to the next auditor who won't have a problem with our revenue. Now all of a sudden, that defeats the purpose of the third-party independent auditor, right? So the auditors themselves have auditors. The Canadian Public Accountability Board. And their primary responsibility is to oversee the Canadian accounting firms that perform the audit engagements. And they will go into the audit firms and look at all of their records and see if you're an auditor and you uncovered something that didn't seem correct or wasn't consistent with IFRS, what did you do about it? If you just sort of said, oh, there's no problem, even though there was clearly a problem, the firm can, the partner can be sued, right? You can get fired. Have you guys heard of Enron or Arthur Andersen? So this was an accounting fraud a while ago in the 90s, I guess. Enron was lying on its financial statements, and the audit firm at the time, Arthur Andersen, which no longer exists, was complicit in the fraud. They knew that things were wrong and they weren't really doing anything about it because Enron was a massive client. Millions of dollars of audit fees. How can you turn that down? Right? If you're a partner, that's paying for your kids to go to private school in your BMW. Right? Why on earth would you say there's a problem here? So lo and behold, Enron goes bankrupt. This is in the States, so the US equivalent of the Public Accountability Oversight Board looked at Arthur Andersen's records and found that so actually Arthur Andersen started shredding the records as soon as Enron went bankrupt. because they knew that they were in trouble. So that's the worst possible thing you can do, because the Accountability Oversight Board might not have found anything if you didn't shred the records, but the fact that you shred the records sort of implies you're guilty, right? It's like if if in a drug bust you're caught flushing something down the toilet, like what do they expect it is, right? So Arthur Andersen, the entire accounting firm, disappeared overnight because they weren't truly independent, right? A lot of partners got sued. A couple of guys went to jail from Enron. Some of the senior executives went to jail from Enron. So this stuff happens in real life, and that's why these oversight boards exist. So now there were, I think, 5 big accounting firms at that point. Now there's only 4 accounting firms. They're called the Big Four. Okay, so that's just some example of all the regulation. In the States, there's a lot more regulation. There's state regulation, there's federal regulation, and there's 15 regulatory bodies. There's people who spend their entire careers just doing regulation. So it's a big thing, and it all stems from the fact that management will lie to get their bonus. And us as investors and the banks as creditors need to be protected. Okay, so this just discusses who management are. This is sometimes called the C-suite. Chief Executive Officer, CEO, Chief Financial Officer, CFO. Sometimes you'll see the Chief Operating Officer, the COO, the Chief Investment Officer, CIO, Chief Technology Officer, CTO. But these are the highest people in the company, and they're elected directly by the board. Board of Directors. Remember, these are hired or appointed, we'll say appointed by shareholders. We as shareholders elect a board of directors to act in our own best interests. And the audit committee is just a subcommittee of the board of directors who decide to hire the independent auditors. Okay, so the independent auditors follow established auditing standards. So there's an entire area of practice devoted to how do you determine that a balance is accurate. Again, imagine you're going into some of these companies that have literally millions of transactions and 100 subsidiaries, and they're global. You can't just look through every transaction. It is physically not possible. So there's audit standards that specify what needs to be done and how much work needs to be done and what the best approach is to get comfort with these balances. It's very judgmental, and it's a very hard area of practice to assess the fairness of the financial statements. Okay, an unqualified opinion. You might hear that word a lot. So unqualified does not mean that the auditor doesn't have the necessary qualification to be auditing. It's not like they're not CPAs. An unqualified opinion is a good thing. It means that the financial statements are presented in accordance with IFRS. One important word here is material. Material in the context of accounting means important. Okay. Would you care if you're looking at Google's financial statements and the cash balance is actually $1,200,000 and $3 or $1,200,000 and $4? You don't really care about that $1, right? That's not a material number. If the difference was $1 million to $2 million, you'd care. So in this case, materiality might be $1 million, but it depends. In fact, in a company like Google, $1 million would not be material because they're so big. Okay, it's like a rounding error to them, $1 million of cash. So materiality is at what point would your decision to invest or not be impacted? So again, it's not set in stone. There's no number that any number over $500,000 is material. But think about materiality in your own life. Okay, if you saw a dime on the ground, you might not stop to pick it up. Okay, I think I heard once that they said so the equivalent analogy for Bill Gates is if he saw $10,000 on the ground, he wouldn't stop to pick it up because it's not worth his time. So to you, 10,000, and to me, $10,000 is material. To Bill Gates, it's not. So materiality is in the context of the company and in the size, right? Information intermediary. So these are the financial analysts. Okay, so they will receive accounting reports from electronic information services. So there's a service called Bloomberg. Bloomberg is probably the most widely used electronic information service for finance. You can look up financial statements, stock prices, any news about the company. So their first step will be to go to that Bloomberg service and collect all this information. They'll also sometimes talk with company executives. They'll talk to the CEO at a press conference and ask questions. And they prepare an analyst report. And they issue this analyst report to clients. And then the client reads it. And so the analyst will have a recommendation. They'll say good stock or bad stock. And here's why. We've done all this work, and here's why we think it's a good stock or a bad stock. More users of financial statements. So institutional investors includes pension plans. I work at the Ontario Teachers Pension Plan. We manage, as I said before, $175 billion for the retired teachers and to-be retired teachers of Ontario. Before we make an investment, you better believe we look at the financial statements. Private investors, this could be you. Once you start working, you have $1,000 to invest. Before you purchase shares, you might want to look at the financial statements. And hopefully by the end of this course, you'll be able to have some level of confidence in looking at a set of financial statements before you invest. Lenders or creditors. So these are banks. Again, the bank mandates that you supply to them every quarter a set of financial statements and once a year audited financial statements because they want to know if you're going to go bankrupt. The disclosure process. So disclosure is information moving to the public market. So company executives, they know a lot about their company and a lot of that information is private. You can't just Google this information and find out about it, okay? So a press release is sort of a formal way for the company to announce things that are happening to everybody at once. So press releases, for example, are used to announce quarterly and annual earnings. So this is a press release excerpt for Thomson Reuters. So Thomson Reuters is the world's leading source of information for businesses and professionals. So they do a lot of reporting themselves. You can get financial information from them. And so these are actual figures. Revenues from ongoing businesses were $3.1 billion, a 2% increase. Operating profit was up 3% to $548 million. EPS, earnings per share, was 48 cents, unchanged. Free cash flow, net cash flow provided by operations. You've seen that before, of $676 million. So without even looking at the financial statements, you already know a lot about how this company is performing, right? And you should now be comfortable enough to interpret all this, right? Maybe before you started this course, you might not have known what a lot of these terms meant. This is an example of a press release. This is real. So companies, if you're private, your annual report is something you prepare once a year, annually. And it'll include, at minimum, the 4 basic financial statements. What are those? Statement of financial position, statement of earnings, statement of cash flows, and statement of shareholders' equity. At minimum, you'll include those. You'll include the notes to the financial statements. The notes have a lot of detail about what's happening within the financial statements. And it will also include the report of independent accountants, or the auditor's opinion. And that will say, that's a cover page to the financial statement. It's a one-page, it's the most expensive page because it costs about $1 million, and it's a standardized one paragraph that's signed by the auditor that says we've performed audit procedures over these financial statements, and we verified that in all material respects, the financial statements are reported fairly. Here, we give an unqualified opinion, meaning you can rely on these. That's $1 million, and they sign it. So that's for private companies. Usually these are pretty small packages. The notes, okay, so the 4 financial statements are usually about 4 pages, maybe 5 pages. The notes are anywhere from 30 to 50 pages. Okay, so you almost always have to read the notes, and sometimes it's like reading a different language, because it's not written for your enjoyment, right? It's written to convey information. And then this is about 1 page. For public companies, remember, these are companies that are traded on stock exchanges. You can go out and buy shares or sell shares of these companies. Okay, the regulators care much more about the public companies because they feel that we as investors need protection. Because you might go and put $2,000 into this stock and it could disappear, right? Annual reports are elaborate due to Securities Commission reporting requirements. So, in addition to all of this information that you see here, the company needs to disclose a ton of information. They need to have a non-financial section with a letter to the shareholders, a description of management's philosophy, products, successes, any recent acquisitions, new markets. And so this can often be 100 pages or more, okay? It's not possible to read all this. That's a problem. Every company comes out with an annual report. The S&P 500 is the 500 largest companies in the US. Each of their annual reports are usually 150 to 200 pages. Do you know how much reading that is every year? If you just wanted to keep up with it, right? It's not possible. So some people complain that there's too much disclosure, there's too much information. So you can see this is kind of examples of what the annual reports will contain. Quarterly reports are issued, as the name would suggest, every quarter. These are unaudited. The reason they're unaudited is because it can take 2 or 3 months to audit financial statements. Meaning by the time you're done auditing one set of financial statements, you'd have to start for the next quarter. So the disclosure is these statements might be materially misstated. Right? Management is issuing these without the auditor having performed verification procedures over them. Sometimes they don't even show the statement of cash flows or the statement of shareholders' equity. And they might not even show the notes. So this is more of a snapshot. It's issued shortly after the quarter ends, so March, June, September. And it'll give you a sense of where the company's heading. But again, it's not nearly as in-depth as the annual reports. These are all fully accessible online. If you're genuinely curious, all you need to do is type in a company name that you know is public and type financial statements. And probably the first Google link will be their most recent annual report and their most recent quarterly reports. And you can read these. These are actual things that they issue. And you'll probably be able to understand a lot of it. You'll know how to read the assets and liabilities and revenues and expenses. We saw this a few weeks ago, right? For the information to be useful, for the financial statements to be useful from a decision context, they have to be relevant, and there has to be faithful representation. What does relevance mean? It has predictive value and confirmatory value, meaning you can confirm what happened, what you thought was going to happen, and it can be verified independently. Faithful representation. You presume, as a reader of these financial statements, that the statements are complete, they're neutral, and they're free from material error. Remember, material means important error. There might very well be $1 million of cash that you can't really find on Google's financial statements, but it doesn't matter because that's not material. You want statements to be comparable, verifiable, timeliness, meaning they're issued shortly after the period end, and they need to be understandable. Understandable to a trained party. They don't need to be understandable to someone who hasn't taken AFM 101. They need to be understand. The presumption is you're an accountant, or you're in finance, or you've taken a lot of accounting courses. Okay, so there's sort of a minimum threshold of understandability. This is the same thing as this, as this. So again, full disclosure requires that not only do we issue a complete set of financials, but you issue notes. We haven't gone over notes. We won't go over notes to financial statements. Okay, but it's sort of the next step. That's what you learn after you learn the basics of accounting. Okay, so what are some constraints when reporting? Okay, the cost constraint suggests that information should be produced only if the benefits of increased decision usefulness exceed the expected costs. What does that mean? Let's go back to the Google example. If you're missing $10 in your Google and it'll take somebody 2 weeks to figure out where it went, how much more decision useful is it to the readers of the financial statements? Not at all. And you're going to pay somebody to spend 2 weeks to find it. So the cost constraint says you shouldn't be undertaking that activity. It's just basic cost-benefit analysis. But financial statements operate under that assumption as well. A lot of people who don't have experience in accounting presume that the financial statements are 100% always completely accurate, which is not the case. Remember what I was saying before, prudence, care should be taken not to overstate assets and revenues. Remember, the incentive is to overstate assets and revenues to make your company look better, or understate liabilities and expenses. So that's the inherent bias. If you were wondering which way would people rather lean. So you don't need to know this. This just shows the difference between, so different accounting standards have different rules for certain items. So you don't need to know this, but notice how IFRS prohibits certain items, whereas US GAAP permits certain items. US GAAP is just the US principles. Everyone else in the world uses IFRS except the US. They use their own accounting standards. Okay, so this is just a review of a classified statement of financial position. This is nothing new. The important thing to note is there's current assets. Current assets. This is classified, meaning short-term and long-term. Current assets, and then they don't explicitly say long-term assets, but by definition, everything below this current assets line is long-term. And these are actual financial statements from Thomson Reuters. You could look this up if you wanted to go back a few years. You can look this up, and these are their financial statement numbers. Notice how there's note references, right? If you wanted to know more about the cash and cash equivalents, you would flip to note 11, and it would give you 2 or 3 pages describing the cash and cash equivalents. What does it mean to be a current asset? Used or turned into cash within 1 year. The opposite of that, long term, used or turned into cash beyond 1 year. Liabilities are classified the same way. You'll have current liabilities, and everything below that is inherently or implicitly long term. And again, the threshold is within 1 year, after 1 year. And then you have your equity. And notice, of course, that the assets are equivalent to the liabilities and equity. Classified statement of earnings. Okay, so the point of classification of statement of earnings is to make this more useful for the reader. We don't just lump all the revenues together and then subtract all the expenses to get to net earnings. That's one method, but it's not very useful. You as a reader care much more about the direct cost of sales, which is the cost of your inventory, to get to your gross profit. Then you have earnings from operations, okay? Then you want separated non-operating revenues and expenses or gains and losses, things unrelated to your day-to-day operations. That'll get you to earnings before income taxes. Then you subtract income tax expense. Why do we subtract income tax expense separately? Because depending on where you're operating, what geographies you're operating in, or how your corporation is structured, you'll pay different tax rates. Investors often look at a company at this level, the EBIT level, earnings before interest and taxes, because income tax expenses can distort the numbers. It can distort your net earnings. Sorry, where's my cursor? It can distort this net earnings even though the earnings before income taxes is exactly the same. The companies might be identical, except for one is structured in a different tax, depending on if you have a corporation in Luxembourg or the Cayman Islands versus in the US, in Delaware, or in Canada. There's different tax rates and different tax structures. And there's people who spend their entire careers, they make a lot of money, telling you, oh, you should incorporate in Luxembourg instead of the US because you'll pay less tax. So they set up an entire complex structure so that they can pay less tax. But that doesn't, just because you pay less tax doesn't mean your fundamental operations are any different. Okay, so it's more like the legal tax structuring side compared to the operations side. So this is an example, consolidated statement of earnings. Right, so in this case, so because Thomson Reuters doesn't really have cost of sales or cost of goods sold, they don't really need gross profit because they're a service-based business. So you can see how they structure their financial statements. But the important thing to note is operating profit. They have this separate line item called operating profit. Right? That's a good indicator of how their day-to-day operations are doing. And they have all these other items impacting, right? They have tax expense down here. They have interest expense here. All this gets you to net earnings. Notice how they have an entire section for EPS, earnings per share. Basic earnings per share from continuing operations is just going to be your net earnings or your operating profit divided by the average number of shares outstanding. This is the same ratio we discussed in class a few times. But companies actually disclose this. And you could recalculate it and you get the same number. If we go back here, you'll see that there's earnings from continuing operations and then earnings from discontinued operations. That earnings from discontinued operations is small, okay? But the question is, why do we separate it? Because we care about items that are continuing and items that are non-recurring. Ultimately, the use of the financial statements is, yes, to get an understanding of how the company did over the last 12 months, But ultimately, we want to have a basis to look forward. We want to try to make an estimate of the future. That's why we care about what's going to recur and what's not going to recur. If Thomson Reuters, in this case, sold one of their businesses that generated $2 million of revenue or a profit, we care that they're selling it. Because if they'd grouped it into the continuing operations, if they'd grouped it here into the continuing operations, we would have thought that that profit is going to continue into the future. But they sold that business. So they broke it out separately to tell the investors that this is non-recurring. Next year, don't expect it. And then earnings per share, which you saw. So it's not, I mean, you don't need to really, I'm not going to ask you to show discontinued operations. You just need to understand that discontinued just means operations that will no longer continue into the future. Sale of a business, closure of a segment, right? Businesses all the time have unprofitable lines of business, right? If H&M wanted to expand into a new province and they open up a few retail stores and find they're not making any money, they might close down the stores within a year. That would get shown as a discontinued operation, right? It happens all the time. All right, earnings per share. Nothing new here. Earnings per share is net earnings divided by the average number of common shares outstanding during the period. That means the beginning balance plus the ending balance divided by 2. Remember, a lot of the journal entries we've seen have been issuance of shares, right? If a company issues shares during the year, its share capital is going to change. So we just want to capture the average. Don't worry about this footnote. We don't talk about preferred dividends until the end of the course. You also don't need to worry about these, okay? Other comprehensive income. I mean, that's some pretty advanced accounting, so don't worry about that. But you just need to know that there's other things that go on in the accounting statements beyond here's how much net earnings you have. The accounting standards boards really like to pull apart all the transactions and be very specific with how you classify everything. So notice here how they have foreign currency translation, okay, and cash flow hedges. Those are two items that are more financing in nature. Companies who have operations in multiple geographies care about Forex, right? If you're a Canadian company and you only operate in Canadian dollars, you don't really care what the Canadian dollar does relative to the US dollar or to the euro. But if you're a Canadian company and you have operations in Europe and in the US, and you earn in euros and US dollars and Canadian dollars, you care very much about how those exchange rates fluctuate. Because that results in real cash impacts, right? The Canadian dollar has become very weak over the last 2 years. It's like $1 US buys $1.40 Canadian, right? So that has an impact to your profits and to your accounting statements. And so there's very specific rules about how to treat that. We don't cover those because it's advanced and there's no need for you guys to know it, but you do see these things come through the financial statements. Consolidated statement and changes of equity. So what we've historically seen in class has been a very simplified version of this, but all it does is show you the beginning balance of equity and then the ending balance of equity and how you get there. And notice how it separates all of these accounts. Share capital, those will be the shares you issued, right? Notice how we started with $10,134,000 of shares and we issued new shares for 38 and we repurchased some shares and we paid shares in stock compensation. So our ending share capital is $10,201,000. There's all these other items. You can see the retained earnings, which you should be recognized with, you should be familiar with. There's all these other items that you don't need to know. Okay, but this just shows a reconciliation year over year. There's a lot of different items that flow into these accounting statements. Nothing new. Statement of cash flows, 3 major sections: operating, investing, and financing. Very important that you know all 3 for the midterm. Here's an example. You can see a lot of the numbers that we use in class as examples actually show up here, right? You see depreciation. You see they start with net earnings. You see there's an addition for depreciation. In this case, notice how there's this one line, changes in working capital and other items, and it's just negative 159, and there's a footnote. If you were to go to that footnote, it would show the breakdown of all the increases in AR, decreases in AP, etc. Okay, but because the statement is already so long, they didn't want to show it all. So you could go to footnote 27 and see the detail of that. Investing activities. Capital expenditures. That's purchase of property, plant, and equipment. In this case, less proceeds from disposals, so they net it. Financing, proceeds from debt. Now, they show it here, even though it's 0 this year, last year they had proceeds from debt. So they have to show a comparative number. But you guys know all this, right? You've seen all these things. And here's the great thing. Because you know how these statements are constructed, if you see that there is a positive in the investing activities, even if you've never seen proceeds from other disposals, you can sort of visualize what it represents because of where it's sitting on the financial statements. You know they must have disposed of a business that resulted in $1.9 million or $1.9 billion, right? Because we're in thousands of millions, $1.9 billion of cash inflow. So you can start to understand, you can start to understand some of these other more complex components. And you might be able to go to footnote 28 and see what this means by acquisitions. That's when they acquire other companies. They paid $1.3 billion for other companies during the year. And you can go to note 28 and see what that means. But so even if you don't know exactly what the line item is, you know where it's sitting on the financial statements. So that you can imply something about it, right? So again, the notes are just descriptions of key accounting rules. Sometimes it'll give you detailed support of the reported amounts, and it'll give you other information not disclosed in the statements, things you care about. So here's an example. One of the first notes to the financial statements is usually significant accounting policies. Notice here how it's note 1. Okay? And here they specify the number of years that they use to depreciate their property, plant, and equipment. They say computer hardware is depreciated over 3 to 5 years. Buildings and improvements are depreciated over 50 to 40 years. And furniture, fixtures, and equipment are depreciated between 3 and 10 years. Okay, so if you're curious how long some of this stuff lasts and what the actual depreciation periods are, here they tell you. Now, it's not that descriptive. 5 to 40 years is not that helpful, right? But it's something. Note 5, operating expenses. So in this case, total operating expenses are showing as $9,762,000,000. So let's just go back to this. Operating expenses, 9,762. Notice how they didn't want to show all those line items because then your financial statement would be this long. It'd be like 6 pages, right? So all they do is they total the amount and they say go to note 5. So you would go to note 5. And you could now see all of the items that go into there. There's staff costs, salaries, goods and services, telecommunications, real estate, and all that totals to 9,762. They'll also show contingencies, commitments, and guarantees. So these are numbers that aren't always shown on the financial statements, but could impact the business. Lawsuits. If there's a lawsuit that's pending, there might not be any liability on the financial statements, but you as an investor would probably care if you think this company is going to get sued and go bankrupt. So here's a pretty detailed description on an outstanding lawsuit with the European Commission, right? So that is it for this chapter. I'll give you guys 10 minutes and then we can do the problems. Okay, there's 2 problems. So let's be back for 10 to 8.